$74.6 billion. That's how much the Federal Reserve injected into the U.S. banking system on December 31st, 2025. Not through scheduled operations, not through routine liquidity management, through the standing repo facility, a tool banks only touch when they're desperate for overnight cash. The largest single-day borrowing in the program's history. Banks pledged $31.5 billion in Treasury securities and $43.1 billion in mortgage-backed securities as collateral. They needed that cash immediately. And on the last trading day of the year, while most Americans prepared for New Year's celebrations, someone on Wall Street was scrambling to keep the lights on. 5 days earlier, on December 26th, the day after Christmas, $17 billion flowed to an unnamed financial institution through the same emergency facility. The Federal Reserve won't disclose which bank borrowed that money for 2 years. Banks don't tap emergency lending the day after Christmas because everything is fine. Connect these two events. $17 billion on December 26th, $74.6 billion on December 31st, both through emergency facilities. And then look at what happened next. On January 2nd, 2026, the first COMEX delivery report of the new year revealed something extraordinary. JPMorgan Chase, the institution that has dominated silver futures, trading for over 15 years, standing for delivery of physical metal in volumes that suggested a complete strategic reversal. After more than a decade of holding massive short positions, suppressing prices, and settling in cash, JPMorgan was now aggressively taking physical delivery. Not selling, not rolling forward. Taking the metal, over 1,000 contracts on that single day moving to actual delivery. JPMorgan taking the majority. Deutsche Bank delivering the metal from their vaults. This was a bank that spent 15 years betting silver would go down, suddenly betting everything on it going up. Here's what they're not telling you. On January 1st, 2026, China implemented the most aggressive precious metals export restrictions since their rare earth controls. Every company wanting to export silver from China now needs a special government license. Annual production capacity of at least 80 tons. Proven export records from 2022 through 2024. Credit lines of $30 million. Only 44 companies qualified for the 2-year licensing period. The official explanation? Resource protection. The actual result? China just locked down 60 to 70% of the global refined silver supply for domestic use. China isn't just a major player in silver, they're the gatekeeper. In 2025, China exported over 4,600 tons of silver between January and November. That flow just stopped. Even if silver is mined in Peru or Mexico or Australia, most of it flows through Chinese refineries before reaching global markets. Those refineries now operate under export restrictions that prioritize domestic industrial demand. Solar panels, electric vehicle components, semiconductor manufacturing, artificial intelligence hardware. All of it requires silver paste and silver conductors that have no viable substitutes. China's industrial consumption already absorbs over 50% of global production. Now they're ensuring none of that metal leaks to Western markets. The timing wasn't coincidental. Throughout late 2025, China's domestic silver inventories collapsed. Shanghai Futures Exchange holdings fell below 500 tons in November. Physical premiums in Shanghai exceeded $8 per ounce above COMEX prices throughout December. Chinese industrial buyers were offering foreign suppliers $8 premiums just to secure metal. The domestic shortage became critical, so on January 1st, Beijing effectively nationalized the global silver supply chain. But this wasn't the beginning of the crisis. This was the moment the crisis became visible. For 5 consecutive years, global silver demand has exceeded supply. The Silver Institute estimates the 2025 deficit at approximately 200 million ounces. The math is simple. Global production, including both mining and recycling, reaches approximately 1.01 billion ounces annually. Demand in 2025 hit 1.24 billion ounces. That's a gap of over 200 million ounces that has to come from somewhere, and that somewhere has been exchange inventories. COMEX registered silver inventories tell the story. In October 2025, registered stocks peaked at 342 million ounces. By early January 2026, that number had fallen to approximately 94 million ounces. That's a 73% decline in 3 months. The metal didn't disappear. Some converted to eligible status, meaning it's in approved warehouses but not available for immediate delivery. Some left the COMEX system entirely. The result? The exchange that sets the global benchmark price for silver is running on fumes. London tells the same story. The London Bullion Market Association reported 844 million ounces in member vaults in October. That sounds substantial until you realize that in October, a single order for 1,000 tons froze the entire London silver market. Silver lease rates exploded from 0.25% to 200% overnight. Every trader withdrew. The Swiss refiner Metalor announced they wouldn't return until January 2026, 1,000 tons, less than 0.4% of reported London inventory, and it shut down the market. What came next changed everything. Silver prices began accelerating in December 2025. On December 1st, spot silver traded near $68 per ounce. By December 29th, it touched $84, a 23.5% rally in under 30 days. But the paper price and physical price began diverging dramatically. While COMEX futures showed $71 per ounce on January 2nd, physical dealers in Tokyo quoted $130. Physical silver in Dubai cleared above $100. South Korean buyers paid premiums exceeding $30 per ounce. When Tokyo dealers charge $58 per ounce above the COMEX price, that's not a premium. That's a separate market. COMEX operates on a fractional reserve system. According to bank participation reports, commercial banks held net short positions of approximately 212 million ounces in early December 2025. But registered COMEX inventory available for delivery sat at 94 million ounces. That's a ratio of 2.25 to 1. For every ounce of physical silver available for delivery, there are over 2 short contracts. When you include the entire futures market, the ratio explodes. Conservative estimates put the paper to physical ratio above 300 to 1. 300 paper claims for every 1 ounce of actual metal. This system works perfectly until someone asks for delivery. And in late 2025, major institutions started asking. India placed orders for over 2,000 tons. South Korea negotiated a $76 billion precious metals purchase directly with Shanghai Gold Exchange, bypassing Western markets entirely. Chinese industrial consumers began securing supply through direct contracts with miners, cutting out the exchange system. Every one of these transactions pulled physical metal out of the fractional reserve system. The breaking point came during the last week of December. On December 29th, silver hit $84 per ounce on COMEX. CME Group immediately raised margin requirements on both gold and silver futures. This was the second margin hike in a week. Shanghai Gold Exchange raised silver margin requirements to 20%. These moves served one purpose: force speculators out and reduce demand for physical delivery. The tactic worked temporarily. Silver pulled back to $71 by January 2nd, but the physical premiums didn't collapse. Tokyo still quoted $130. The paper price fell. The physical price stayed elevated. Here's what the margin hikes revealed. Exchanges have one nuclear option when delivery demands exceed available inventory. Rule 5.8.9 allows CME to halt physical delivery and settle contracts in cash at administratively determined prices. It's never been used for precious metals, but the margin hikes signal that exchanges are preparing for that possibility. Because if institutions holding 300 paper claims per ounce all decide they want delivery at once, there's only one way that story ends. Remember the Federal Reserve's emergency lending. $74.6 billion on December 31st, $17 billion on December 26th. Now consider what happened to JPMorgan. Reports showed JPMorgan moving from their traditional role as silver short to aggressively standing for delivery, taking physical metal in massive quantities. After 15 years of documented silver manipulation, paying $920 million in fines to the Department of Justice in 2020 for spoofing precious metals markets, JPMorgan suddenly reversed course. The math tells you why. If you're holding a massive short position and the physical market is about to break, you have 2 choices. Cover your shorts, which drives prices higher and locks in losses. Or flip long, take delivery of physical metal, and profit from the coming squeeze. JPMorgan chose option 2, but taking delivery requires capital. Billions in immediate liquidity. Connect the dots. JPMorgan flips long in late December. The Federal Reserve injects $74.6 billion into the banking system on December 31st. The standing repo facility exists to provide emergency overnight funding to banks that can't access normal lending channels. The timing is undeniable. JPMorgan needed liquidity to take delivery of physical silver before China's export restrictions kicked in on January 1st and before other institutions realized the physical market was breaking. The Fed provided that liquidity through emergency facilities that signal distress. This was the Federal Reserve providing the cash JPMorgan needed to corner physical silver before the squeeze became obvious. By January 2nd, JPMorgan controlled a substantial portion of January deliveries. Deutsche Bank was forced to deliver physical metal from their vaults to satisfy JPMorgan's demands. This changes everything. For over a decade, JPMorgan's short position in silver has been the anchor holding prices down. Every rally got sold. Every delivery month saw a cash settlement. The bank paid billions in fines for manipulation, but kept manipulating because the profits exceeded the penalties. Now they've surrendered, not because they found ethics, because the physical market broke before they could fully unwind their shorts. And when the bank that has controlled silver pricing for 15 years suddenly reverses course and starts accumulating physical metal, that's not a trading decision. That's a survival decision. The implications extend beyond silver. If COMEX defaults on physical delivery, if exchanges are forced to cash settle contracts because the metal doesn't exist, the entire commodities future system comes into question. Oil, natural gas, copper, wheat, every commodity traded through futures contracts operates on the same fractional reserve model. Silver isn't just a financial instrument. It's a critical industrial input with no substitutes. When industrial buyers can't get physical delivery, they stop trusting the exchange and start building private supply chains. That's already happening. China understands this perfectly. Their January 1st export restrictions aren't about environmentalism. They're about industrial sovereignty. The transition to renewable energy requires massive quantities of silver. Every solar panel needs silver paste, approximately 20 grams per panel. China produces 70% of global solar panels. Every electric vehicle uses between 15 and 30 grams of silver. China produces 60% of global EVs. Every AI data center server uses silver-plated components. China dominates server manufacturing. Beijing looked at the numbers. Domestic consumption rising, global production flat, Western exchanges offering paper contracts backed by nothing. The decision was obvious: lock down the supply, control the refining, prioritize domestic industry. The United States government recognizes the threat. In early November 2025, the Bureau of Industry and Security classified silver as a critical mineral. The designation triggers a review process scheduled for January through February 2026. If the review concludes that import dependence on China-controlled silver supply compromises American defense and technology sectors, expect tariffs and strategic stockpile accumulation. But those responses take years to implement. Mining projects require over a decade from discovery to production. The immediate crisis is already here. Smart money sees what's coming. Silver exchange traded funds recorded outflows in early January as institutions converted paper holdings into allocated physical positions. Total known global silver ETF holdings stood at 850 million ounces as of January 7th. That's down from 871 million ounces on December 23rd. 21 million ounces withdrawn in 2 weeks. Those ounces didn't get sold. They got converted to physical and moved to private storage. Private vaults reported unprecedented demand. Wealthy individuals in Asia began accumulating kilogram bars. Industrial consumers started renegotiating supply contracts to include guaranteed physical delivery rather than cash settlement options. Every one of these moves pulls metal out of the exchange system and into private hands. And once metal enters private storage, it rarely comes back. The sellers want physical. The buyers want physical. The exchanges offer paper. That disconnect is permanent. The pressure intensified through the first week of January. On January 8th, 2026, the Bloomberg Commodity Index began its scheduled rebalancing. Silver's dramatic price appreciation meant passive index funds now held overweight positions. Approximately $6 billion in silver futures contracts would be sold over 5 trading sessions. This wasn't discretionary selling. This was forced liquidation by algorithms. Silver dropped from $76 on January 7th to $73 on January 8th. But the physical market didn't budge. Tokyo premiums stayed above $50 per ounce. Shanghai held its $8 premium. The index rebalancing removed $6 billion in paper exposure. Physical demand absorbed it without flinching. Behind the visible price action, bank positioning reports revealed extraordinary stress. Commercial banks held net short positions exceeding 200 million ounces in early December. That short position represented approximately 2.1 times the entire registered COMEX inventory. JPMorgan's flip to standing for delivery suggested they not only covered their shorts, but reversed to net long. That means someone else now holds the concentrated short position. Deutsche Bank's December deliveries indicate they're reducing inventory. Citigroup remains notably absent from recent delivery reports. The silence from certain major banks speaks volumes. When Bank of America and Citigroup stopped participating in delivery months that historically saw their active involvement, that absence signals either strategic withdrawal or inability to fulfill obligations. Reports suggest certain institutions are negotiating cash settlements for contracts that were supposed to deliver physical metal. These settlements happen quietly, no announcements, no filings. Just private agreements where buyers accept cash instead of demanding the physical silver they purchased. If true, these represent de facto defaults. Once that guarantee becomes negotiable, the entire pricing mechanism loses credibility. The margin hikes in late December served dual purposes. The official explanation focused on volatility management, but experienced traders understand margin hikes as demand destruction tools. When you raise the capital required to hold a futures position, you force leveraged players out. Speculators liquidate. Prices drop. Except this time, the mission only half worked. Prices dropped temporarily, then stabilized. then started climbing again. Because the margin hikes removed speculative length but did nothing to address the underlying physical shortage. Industrial buyers don't use leverage. Margin requirements are irrelevant to them. The comparison to the Hunt brothers' silver manipulation of 1979 and 1980 is inevitable but misleading. The Hunts attempted to corner the silver market through massive futures purchases. At their peak, they controlled approximately 200 million ounces. Their manipulation drove silver from $6 to $50. Then COMEX changed the rules. Margin requirements increased. The Hunts couldn't meet margin calls. They defaulted. Silver crashed. The comparison to 2026 breaks down immediately. The Hunts were individual speculators attempting artificial scarcity. The current crisis reflects actual industrial demand exceeding mine supply for 5 consecutive years. You can break a speculative manipulation by changing exchange rules. You can't break structural supply deficits by raising margins. What makes 2026 different is China's role. In 1980, the United States dominated both silver production and refining. When prices spiked, domestic mines increased output. In 2026, China controls 65% of refined silver supply and 70% of global solar panel production. They're not speculating. They're securing industrial inputs for their manufacturing base. You can't break that by changing COMEX rules. The leverage point shifted. Western exchanges no longer control price discovery when Eastern industrial demand determines physical availability. The global commodity system spent 7 decades operating under American financial dominance, dollar-denominated contracts, New York price discovery, London settlement. That era is ending, not through dramatic collapse, but through gradual irrelevance. When physical buyers stop referencing COMEX prices and start negotiating directly with refiners and producers, the exchange becomes a side market for financial speculation disconnected from physical reality. Tokyo dealers charging $130 while COMEX shows $71. That's not arbitrage. That's 2 separate markets. One trades paper, one trades metal. The Fed's $74.6 billion injection now appears less like crisis management and more like system preservation. If JPMorgan needed emergency liquidity to flip from short to long, that transaction prevented immediate default and gave the broader market time to adjust. But adjustment requires either demand destruction or supply expansion. Neither is happening. The Silver Institute projects 2026 demand at 1.28 billion ounces against supply of 1.03 billion ounces, another 250 million ounce deficit. The 5th becomes the 6th. The crisis compounds. And the Federal Reserve's 74 billion bought time, not solutions. The real question isn't whether the system breaks. The question is who's holding short positions when it does. Because someone is. JPMorgan surrendered and flipped long. Deutsche delivered metal and reduced exposure, but 200 million ounces of commercial short interest didn't vanish. It transferred, and whoever holds it now is trapped. They can't cover without driving prices vertical. They can't deliver because the physical metal doesn't exist in sufficient quantities. Their only hope is demand destruction through economic collapse. Anything short of global recession means the squeeze continues until someone defaults. That's not speculation. That's mathematics. Physical supply minus physical demand equals deficit. And deficits get resolved through prices or defaults. There's no third option. Prices rise until industrial buyers start substituting alternatives or reducing consumption. Or shorts default because they can't deliver metal they promised. Either path ends the same way. Credibility destroyed, trust shattered, market structure permanently changed. The weight of what's happening settles in when you realize this isn't a temporary squeeze. This is a structural repricing of a commodity that has been systematically undervalued for decades. Silver traded at $20 per ounce in 2011. For 14 years, prices stayed suppressed despite growing deficits, despite increasing industrial demand, despite inflation. The suppression happened through paper markets that created unlimited supply regardless of physical availability. That mechanism just broke, not because regulators stopped it, because physical reality asserted itself. You can print unlimited paper contracts. You can't print silver bars. JPMorgan's surrender marks the end of an era. For 15 years, they controlled silver prices through concentrated short positions and high-frequency trading algorithms. They paid fines when caught manipulating and continued manipulating because it remained profitable. Now they've flipped long, taking delivery, accumulating physical. And if JPMorgan, with all their resources, all their trading infrastructure, all their regulatory protection, couldn't maintain the short manipulation, no one can. The question now isn't whether silver prices rise. The question is how high they go before supply and demand reach equilibrium. And in a market with 5 consecutive years of structural deficits, with China locking down 65% of supply, with exchange inventories down 70%, and with the largest manipulator in history, surrendering and going long, that equilibrium is nowhere in sight. Some analysts project silver reaching $150 per ounce by year end. Others suggest $300 if supply chains break completely. Those aren't predictions. There are scenario analyses. If deficits continue, if China maintains restrictions, if more banks flip long, then prices go wherever they need to go to balance the equation. The Federal Reserve's $74.6 billion injection on December 31st wasn't about year-end liquidity. It was about preventing immediate collapse. The unnamed institution that borrowed $17 billion on December 26th remains unnamed because disclosure would trigger panic. Someone was on the wrong side of the silver market and needed emergency funding to survive. The Fed provided it to prevent contagion because if one major bank defaults on precious metals contracts, every counterparty reevaluates their exposure. Every trading desk reassesses their positions. Every institution with short exposure rushes to cover, and that feedback loop becomes unstoppable. This story isn't over, it's accelerating. The data will keep coming. COMEX delivery reports each day. Chinese export license approvals each month. Federal Reserve balance sheet updates each week. Exchange inventory levels in real time. Watch the numbers, they don't lie. And when the world's most powerful investment bank surrenders a 15-year manipulation campaign and starts desperately accumulating the same metal they spent decades suppressing, you pay attention. Because they know something. They saw something in the data that forced a complete strategic reversal. And whatever JPMorgan saw, it scared them enough to abandon the most profitable trade in modern precious metals history.